Hi, Assalamualaikum. So my group will be present chapter 22 regarding audit of capital acquisition and repayment cycle. I'm the first presenter. My name is NAJLAA, and firstly I will explain three parts in this chapter. The first is characteristic of capital acquisition and repayment. The second one is what account that involved in the cycle. The third is methodology for designing tests of detailed balances for account. This is the learning objective 1. And for the next slide, I will explain about the 5 type of circle before we get into the characteristic of the capital acquisition and repayment cycle. So we need to recall that we have learned 5 type of cycle in audit 2. Which is the first one is sales and collection cycle, which we learn about the process that the company will do to transfer the ownership of goods and services to the customers. Second, we learn about acquisition and payment cycle, which is the process of the company buying raw materials, equipment, tools and others. And we learn also a payroll and personal cycle, which involve employment, which stated about employment and the payment for all employees or labor in the company. And we learn about inventory and warehousing cycle. This one is a unique cycle because it has related and close relationship with the other cycle. For example, for acquisition and payment cycle, they will put the goods that they purchase in the inventory warehousing, so they have a close relation with the other cycle. And lastly, for our topic is capital acquisition and repayment cycle. This cycle is related with the acquisition of resources through interest bearing debt and owner equity, and it also involves the payment for interest and dividend. Might I say the example, bonds or shares, or common share or preferred share. For the next slide, I will explain about the characteristic of capital acquisition and repayment cycle. So it has 4 characteristics. We will jump straight to number 1. Number 1 is relatively few transactions affect the account balances, but each one is often highly material. Okay. For this part, it says that capital acquisition have a few transactions in a company, but each transaction have a large amount. So I give you example. We have bond. For a company to issue bonds is actually rare for a company to issue bonds, but once they issue the bonds, the value of the bonds is higher, large. So auditor have a responsibility to verify the balance sheet account and transaction that occur in the entire year. What auditor need to do? Because of the large amount, auditor need to verify and view the beginning balance, if any transaction occurred during the year, and also the ending balance. For the second characteristic, it is about the exclusion or misstatement of a single transaction can be material. If auditor happen to forgotten or overseen the misstatement, it can cause a material in the financial statement. Therefore, they need to be alert to view and recorrect any misstatement. So the auditor have highlighted the most important part in auditing this account is on the completeness and accuracy of balance related audit objective. For the third point is a legal relationship exists between the client entity and the holder of the share, bond or any similar ownership document. When a company issue a bond, share or any related, any similar related document, automatically they have create a legal relationship between the bondholder, between the shareholder, or owner of any similar document. So the auditor have to ensure that client have followed the legal requirement of debt or equity agreement, and auditor must ensure that client will disclose adequately in financial statement if it gives effect to the financial statement. Next, for point 4, a direct relationship exists between the interest and dividends account and debt and equity. When we audit interest-bearing debt account, auditor should also verify the related interest expense and also interest payable. And this also apply for owner's equity, dividend declared, and dividend payable. For the next slide, we will continue to the accounts that involve in the capital acquisition and repayment cycle. There is several accounts that involve in this cycle, but actually it depends on the company operation and the and how the operation are financed. The first one is notes payable. So the notes payable is actually a promise note, or we can call as agreement between the borrower and lender. The borrower has agreed to pay the lender the amount that he owes within a specific time. Next, we have a contract payable. Contract payable is monthly or installment payment to the contract owner. Contracts such as rent contract or loan contract. We have mortgage payable. Mortgage payable is actually long-term liability for us to purchase property. So if he or she have paid full to own the property, then the ownership of the property will transfer to him. We have a bonds payable. It also a long-term liability, usually issued by corporation or government, and corporation or government promise to pay interest to any bondholder. We have interest expense and also accrued interest. Next is appropriation of retained earning. We have also treasury share, and the treasury share is actually share that the company issue and the company buy back the share, so to sell to the public, so it called as treasury share. We also have cash in the bank. Next is capital share, common share, and preference share. We also have paid in capital in excess of par. Next we have donated capital. Okay. For donated capital, is actually an asset that is given to the company as a gift. For example, a local community give a free land to the company because the company has agreed to build a charity building at that land. We have also retained earning. We have dividend declared and dividend payable. Okay, for dividend declared, it's actually dividend that have been authorized by board of director, but this dividend did not yet pay to the shareholder. For dividend payable, it exists once the board of director declare the dividend. So we have proprietorship, capital account, and capital account of partnership. Next slide is regarding methodology for designing test of detail balance of account. For the next slide, I will explain about the methodology for designing test of detail balances of account. This methodology design is similar with the methodology design in sales and collection cycle. The only difference is the name of the account. So I give an example, which is notes payable. So during auditing a notes payable, the auditor will consider a few types of matters. The first one is business risk, tolerable misstatement, inherent risk, control risk, result of test control, result of substantive test of transaction, result of analytical procedure. For the next slide, this is the methodology for designing test of balances for notes payable. We have three phases: phases 1, phases 2, and phases 3. This is a phases 1. So, identify client business risk affecting notes payable. Business risk means any exposure. It is exposure of a company towards the risk that can cause them reduce in profit and failure in business. Next one, we have set tolerable misstatement and assess inherent risk for notes payable. Tolerable misstatement means a reasonable amount set by the auditor to accept the financial statement of the client. Inherent risk is like auditor assessment that it is likelihood to have misstatement before considering the effectiveness of internal control. And lastly, we have control risk, which also auditor assessment that is likelihood the misstatement has exceeding the tolerable amount and cannot be prevented or detected by client internal control. We will proceed to the next slide. On this slide, this is the methodology design. So the phase 1, we first will identify client business risk affecting notes payable, which I already mentioned before. And the second one, we set tolerable misstatement. Okay, for setting the tolerable misstatement, usually auditor will set at lower level because usually they will be able to complete the audit. And assess inherent risk for notes payable. The inherent risk also will be set at low level because normally they can determine the correct account value easily. The phase 1, number 3, the assess control risk for notes payable. Control risk is less important for auditor because there is only few transactions exist in the company. For the next slide is phase 2. Phase 2 is design and perform tests of controls and substantive tests of transaction for capital acquisition and repayment cycle. Next slide. For the substantive test of transaction, when we test it and we get the result, actually the result is not really important, less important, because like I said before, we have only a few transactions. Next is phases 3. For phases 3, design and perform analytical procedure for notes payable. And we have design tests of detail of notes payable to justify balance related audit objective. Next slide. Justify balance related audit objective. Auditor normally will more concentrate or concern about the completeness objective for notes payable account balance and the completeness objective for notes payable disclosure. For auditor, it is very concerned for them to justify the balance related audit objective rather than transaction related audit objective. It is because a few transactions that occurs in the company. So, for you to understand more about the notes payable, I will pass this part to Razmiela JAMIETA after this.
Thank you to NAJLAA as for her previous explanation. So I hope that all of you can catch up and can understand and can fully understand her explanation and can catch the main point. Okay, so for the next subtopic, which is the notes payable. So under this agreement, a borrower obtains a specific amount of money which they borrow from the lender and promises to pay it back to the lender with interest and during a predetermined period time. So basically, in a simple words, the notes payable is the agreement, the loan agreement between two entities, including the borrower and the lender. The lender may require a restrictive contract as part of the note payable agreement. So in this slide, some notes payable are secured because which means the creditor has a claim on the borrower's assets if the payment terms are not met. If it is secured, the timeline of repayment could be longer. So it's like when the borrower are not making a scene or not making a problem during the period time of the repayment, then possibly the borrower will extend the payment time period, the repayment time period. Meanwhile, for unsecured note, it is not backed by any guarantee and thus presents more risk to lenders, as even though they have a contract, but it has no guarantee in the future, so it might causing a high risk to the lender itself. So usually a note is issued for a period somewhere between 1 month and 1 year. However, longer term notes do exist. Notes are issued for different purposes, which and the property pledged as collateral includes a wide variety of assets, including securities, account receivables, fixed assets, and inventories. So what mean by pledged collateral? It refers to assets that are used to secure a loan. For example, a borrower pledges his assets to the lender to guarantee or to secure the loan. In Malay, we call it as cagaran. So for the next slide, the principal and interest payment on the notes must be following the terms of the loan agreement. For short-term loans, interest payment is usually required only when the loan becomes due. So for loans over 90 days, the note usually calls for monthly or quarterly interest payments. When a company borrows money under a note payable terms, then the cash that they receive will be debited, meanwhile the notes payable will be credited. Okay, so for this slide, you can refer to page 680, figure 22.1, which shows the accounts used for notes payable and other related interests. Usually, auditors will include tests of principal and interest payment as a part of auditing the acquisition and payment cycle. It is because the payments are recorded under the cash disbursement journal. However, in many cases, there are no capital transactions are included in the auditor's sampling for test of control and substantive test of transaction. So auditors do not prefer to do sampling for test of controls and substantive test of transactions, as there is relative infrequency because of there is only a few transactions that occur in the company. Therefore, it is normal to test these transactions under the capital acquisition and repayment cycle. So, we're gonna move to the next slide, which is regarding the objectives of audit of notes payable. So as for the first objective is to determine whether the internal control over notes payable are adequate, which means the internal control are acceptable or not. So for the second objective is to determine whether the transactions for principal and interest involving notes payable are properly authorized or recorded in accordance to the 6 transaction related audit objective, which oblique the transactions are recorded according to occurrence, completeness, accuracy, posting and summarizing, classification and timing. The last objective is to determine whether the liability for notes payable and related interest expense and accrued liability are properly stated. Next, we're gonna move to the internal control, which is the 4 important controls over notes payable. For the first control is the proper authorization for the issues of new notes. The second one is adequate controls over the repayment of principal and interest. The third one is the proper documents and records. And the last one is periodic independent verification. So, for the proper authorization for the issues of new notes, the responsibility for the issuance of new notes should be vested or conferred to the BOD, which is Board of Director or high-level management personnel. So, basically, for loan agreements, there must be 2 signatures of properly authorized officials were required. The agreements are specified, which is including the repayment terms, the amount of loan, the interest rate, and the assets pledged, and others. So, when the notes are renewed, they need to be procedures for the issuance of new notes. So, for the second point, which is the adequate controls over the payment of principal and interest, the periodic payments of principal and interest should be concerned to the controls in the acquisition and payment cycle. So at the time the note was issued, the accounting department should have received a copy of note which is similar when they receive the vendor's invoices or the receiving reports. After that, the account payable department should automatically issue checks for the notes when they become due. Again, same like when it prepares the payment for acquisition of goods and services. The copy of the note that the accounting department received should provide the supporting documents for payments such as receipts, invoice, and proof of payments. So for the third objective, the explanation is regarding the proper document and records, which this include the subsidiary records and control over blank and paid notes by an authorized person. So paid notes should be cancelled and under the charge of an authorized official. Last but not least, regarding the explanation regarding the periodic independent verification, the detailed note records should be reconciled with the general ledger regularly and compared with the note holders records by an employee who is not responsible for maintaining the detailed records. But at the same time, an independent person should recompute the interest expense on notes to test the accuracy of the record keeping. So I hope that you might understand. So I will pass the next subtopics to my friend, to my group mate, Alia Farhani.
Okay, so for the first one is the test of control and the substantive test of transaction. So for the test of control is actually one of the audit procedure that is used to test the effectiveness of the control used by the entity to detect the material misstatement. But however, if the results turn to show that the control of the company is weak, the auditor needs to enhance the substantive testing, which will usually increase the cost of audit, because the auditor need to do a lot of tests and to get more evidence just to detect the material misstatement. So the test of notes payable transaction involve the issue of notes and the repayment of principal and interest. Audit tests, or also known as audit procedure, are a part of test of control and substantive test of transaction for cash receipt and also cash disbursement. So for the cash receipt,
you can turn to page 435, look at the table 14.3, and for the cash disbursement, turn to page 579 for the table 18.3. So from the table, it will show the transaction that related to audit objective that use the audit procedure like test of control and substantive test of transaction to detect the material misstatement towards the transaction. So for the additional tests that of control and substantive tests of transaction that are often done as a part of test detail balance because of the materiality of individual transaction. The test of control for notes payable and related interest should emphasize by testing the 4 internal control that we just discussed before, which is the first one is the proper authorization for new notes. Second one is adequate control over payment, principal and interest. The third one is proper document and records. And the fourth one is periodic independent verification. Other than that, auditor also needs and should verify the accurate recording of receipt from notes proceed and payment of principal and interest. So moving on to the next one, which is analytical procedure. So for the analytical procedure, which are essential or important for notes payable because of test of detail for interest expense and accrued interest can often be eliminated when results are favorable. As we know, the summary for analytical procedure is to identify the possible misstatement, reduce the detail test, and also assess going concern issue. So, to detect from the transaction, if we want to detect the analytical procedure, we have to find the 3 keywords, which is the first one is we have to compare the analyzation. The second one is the compare between the ratio required amount in the transaction. The third one is to identify if any unusual transaction occur. So the next one is from the table 22.1 at page 681. They show that they have the 3 analytical procedure and also 3 possible misstatement. So for the first one is recalculate approximate interest expense on the basis of average interest rate and overall monthly notes payable. So the possible misstatement that might happen is misstatement of interest expense and accrued interest or omission of an outstanding note payable. So moving on to the second one, which is we need to compare the individual notes outstanding with those of the prior year, which is the year before. So the possible misstatement that might occur is omission or misstatement of a note payable. So the last one is we have to compare the total balance in notes payable, interest expense and accrued interest with the prior year balance. So the possible misstatement that might happen or occur for that analytical procedure is misstatement of interest expense and accrued interest or notes payable. So for auditor independent prediction of interest expense using average note payable outstanding and average interest rate, it might help the auditor to evaluate the reasonableness of interest expense and also test for omitted notes payable. So for an illustration of an auditor schedule where such analytical procedure has been performed, you can turn to page 217 and look at the figure 8.8 in chapter 8. At the table, they will show you the analytical procedure that has been performed by the auditor.
Hi, I'm Nur AMIZA. Today I would like to present about the test of detailed balance, which is referred to the capital acquisition and repayment cycle. So, for this topic, the most important balance-related audit objective for notes payable is completeness and accuracy. For the completeness, existing notes payable are included, and for the accuracy, notes payable in the schedule are accurately recorded. So, this is the summarizes the applicable for the balance-related audit objective for notes payable and interest. The first audit objective is the detailed tie-in. For example, the notes payable in the schedule agree with the client's master file, and the total is correctly recorded at the general ledger. The second one is the existence. The notes payable in the schedule is exist. The third one is the completeness, which is existing notes payable are included in the notes payable schedule. The fourth one is the accuracy. For example, notes payable and accrued interest on the schedule are accurate. The fifth one is the classification. Notes payable in the schedule are correctly classified. The next audit objective is the cut-off, which is the notes payable are included in the proper period. The last one is the obligations. The company has an obligation to pay the notes payable. In addition to the balance-related audit objective, the four presentation and disclosure related objectives are presentation and disclosure and the rights and obligation. For example, the accounting standards require that the footnotes adequately describe the terms of notes payable outstanding and the assets pledged as collateral for the loan. Next, we move to the honest equity. Honest equity is divided into two, which is closely held cooperation and publicly held cooperation. For the closely held cooperation, there are a few shareholders and a few capital account transactions during the year. The transaction can be in the honest equity is for the changes in honest equity for the annual earning or loss and the declaration of the dividends. Furthermore, most closely held cooperation do not pay dividends or rarely pay dividends. So the next one is the publicly held cooperation. For the publicly held cooperation, the verification of honest equity is more complex because they have more shareholders and frequent changes in ownership of the share. So, the major honest equity for the accounts is capital and common shares, paid in capital in excess of par, retained earnings and related dividends. So, this slide is an overview of the major honest equity accounts in the publicly held corporation, which is we have the common shares, dividend payables, retained earnings, cash or bank accounts, and also paid in capital in excess of par. So, the objective of the honest equities account is to determine whether the internal controls over share capital and related dividends are adequate. Second, the honest equity transactions are correctly recorded, which is we have 6 transactions related audit objective. And the last one is the honest equity balances are properly recorded.
Hi, Assalamualaikum warahmatullahi wabarakatuh. My name is HAZIRAH binti ISMAIL. So, I will continue with the next part, which is internal control. So, in the internal control for honest equities, there are 3 parts, which is the first one, proper authorization of transaction. The second one is proper record keeping and segregation of duties. And the third one is independent registrar and share transfer agent. So, I will continue with the first explanation of proper authorization of transaction. So, the first one is in proper of authorization transaction, each of honest equities transaction must have to get approval from the board of directors. There are few types of transaction that needs a proper approval authorization from the board of directors, which is the first one is issuance of capital shares, the second one is repurchase of capital shares, and the third one is declaration of dividends. For issuance of capital share, the authorization include the type of equity to issue, the number of shares, par value of shares, and privilege condition for each share, and the date of time. The next one is repurchase of capital share. In this repurchase, it must have include the common preferred shares, the timing of the repurchase, and the amount to be purchased must be approved by the board of the directors. And the last one is declaration of the dividends. In this declaration, the board of directors must authorize the form of the dividends, such as the amount of the cash that needed to be paid for dividends. The next activities in internal control is proper record keeping and segregation of duties. When a company maintains its own record of stock transaction and outstanding stock, the internal control must be adequate to ensure that actual owners of the stock are recognized in the corporate records. The next one is the correct amount of dividends is paid to the shareholder owning the stock of dividend record rate. And the last one is the potential for misappropriation of asset is minimized. Therefore, the disbursement of cash payment of dividends should be controlled in such manners as the preparation and payment of payroll. In the internal control, it may affecting the dividend payments, such as dividend checks are prepared by capital share certificate recorded by someone who is not responsible for maintaining the capital share records. The next one is after the checks are prepared, there is independent verification of shareholders' names and the amounts of the checks, and a reconciliation of a total amount of the dividend checks with the total authorized dividend in the minutes. And the last one is a separate impressed dividend account should be applied in order to prevent the payment that was large being authorized. The last activities in the internal control are independent registrar and share transfer agent. So the company are required to engage with the independent registrar as a control to prevent the improper issues of share certificates. This is to ensure that the share issues is issued by a corporation accordance with share provision. The independent registrar are responsible to signing all new issued share certificates when there's a changing in ownership of the shares. Other than that, usually a large company, they will hire a share agent transfer. The share agent transfer are required to maintain the shareholders' records, including the documentations, transfer of share ownership. Therefore, there are also many companies that have the transfer agent disburse cash dividends to shareholders to further improving their internal controls. That's all for the internal control parts. So I'll continue to the next part, which is the learning objective that we will learn at the next part is the design and perform tests of control, certainty step of transaction, and test of details of balance for capital shares and retained earnings. So in the audit capital share and paid in capital, there are a few main concerns by the auditors, which is the first one is existing capital share transaction recorded. The second one is recorded capital share transaction occur accurately recorded. And the third one is capital share is accurately recorded. The fourth one is capital shares is properly presented and disclosed. So I will go with the first concern. The existing capital share transaction are recorded are related with the audit objective, which is completeness. So in order to achieve this objective, the process for the auditor to achieve this objective can be more easier if the company hire or employ the independent registrar or transfer agent, because the auditor need to confirm from the independent registrar and share agents whether is there any capital share transactions occur and accuracy of existing documents. Also, they have to verify and determine all of the transactions have been recorded. Other than that, the auditor have to uncover all the issuance and repurchase of the shares in the company. So, in order to do that, they have to review of the balance sheet and minutes of the board of directors meetings and compare it with the registrar or transfer agent's share records. Next, the recorded capital shares transaction occur and accurately recorded. This is related with the audit objective of occurrence and accuracy. So, the extensive auditing are required when there are several activities occur, which is if there are any new issuance of shares, or if the company combine with others company and they exchange through the shares and the company donated the shares, and the last one is the purchase of treasury shares. In addition, the auditor have to verify whether the correct amount are credited to the account and capital shares and the paid-in capital in excess of par by referring to the corporate charter to determine the par or stated value of the capital shares. The next one is the capital share is accurately recorded. This is related with the audit objective of accuracy. So, the auditor can have and obtain the confirmation from the independent registrar and the agent transfer shares. But if there is no agent at the company or independent registrar at the company, the auditor have to rely on the information given by the company based on examining on the shares record and the accounting record for all of the shares issued and outstanding in the certificates record. Also, they have to examine all the cancel certificates and accounting for a blank certificates. The ending balance in the capital in the excess of par account is a residual amount. So, it will be audited by verifying the amount recorded transactions during the year and adding them to or minus it from the beginning balance in the account. The main consideration when auditing the accuracy is to verify whether the number of the shares used in the calculation are accurate with the earning per share. And the last one is the capital shares is properly presented and disclosed. This is related with the audit objective of presentation and disclosure. In order to satisfy with this audit objective, the best sources of information that the auditor can get is from the chartered corporate, the minutes of the board meetings, and the auditor analysis of capital share transaction. The auditor has to determine each class of share has a proper description, including the number of the shares issued and outstanding, and any special rights of an individual class. Other than that, the auditor also have to verify the proper presentation and disclose of stock options, stock warrants, and convertible securities by examining the legal documents or other evidence of the provisions of this agreement. That's all from me, so I will pass to the next presenter. Thank you.
Hi, Assalamualaikum. My name is SYAHIRA and I'm going to explain to you guys about audit of dividends and audit of retained earnings. So first, audit of dividend. As you can see at the slide, there is 6 transaction related audit objective. For transaction for the audit of dividend, there is accuracy, completeness, and accuracy. So, auditors can validate the occurrence of dividend recorded by reviewing the minutes of the meetings of the board of directors to confirm the amount of the dividend per share and date of the dividend, or to verify the dividend that dividend was authorized. So when the auditors doing it, the auditor should be alert to the possibility of unrecovered dividends being reported, especially shortly before the balance sheet date. And a similar audit procedure is to analyze the permanent audit file to determine if there are any limits on the payment of the dividends under preferred stock indenture bond agreements. Next, the accuracy of the dividend declaration may be verified by recalculation the amount of the basis of the dividend per share times the number of shares outstanding. For example, if your client using an outside agent to process the cash dividend, use a confirmation to verify the dividend transaction. Also, because the client has to make payment to the dividend this agent before the payment of the dividend can be processed, so you can check the transaction by reconciling the payment or to the total amount you receive by multiplying the dividend declared by the number of shares outstanding. So, if the customer keeps the record of his own dividend and pay the dividend himself, so the auditor can check the total amount of the dividend by calculation and reference to the cash disbursement. And also, auditor must verify whether the payment was made to the shareholder who own the share as of the dividend record date. So, we can verify this by choosing a sample of the dividend payment reported and tracking the name of the payee, the payer's name on the cancel check in the dividend records, and around at the same time, auditor will verify the amount and accuracy of the test of the dividend. So, next is audit of retained earnings. There are two transactions involving of retained earnings, which is net earning of the year for the year and dividend declared. So, to begin your audit of retained earnings, first the auditor must analyze the retained earnings for the entire year. Firstly, you must get a schedule from your client that shows how the client got from the beginning to the ending of the retained earnings for the year ended. The audit schedule shows the analysis, which is usually a part of the permanent file, includes a description of every transaction affecting the account. to accomplish the audit of the credit to the retained earnings for the net income for the year, auditor must trace the entry in the retained earnings to the net earning figures or loss adjustment on the client income statement. This procedure must take place fairly late in the audit after all adjusting entries affecting net earning have been completed. In auditing debit and credits to retained earning other than net earning and dividends, auditor must determine whether the transaction should have been included. For example, prior period adjustment. Okay, this adjustment can be included in retained earnings only if they satisfy the requirements of accounting standard. If the client reflects any of the prior period adjustment, confirm that these are indeed errors that can be corrected by making adjustment to retained earnings. And then, after the auditor is satisfied, the next step is to decide whether they were accurately recorded. So, the audit evidence necessary to determine accuracy depends on the nature of the transaction. For example, if an appropriation of retained earnings is required for bond sinking fund, auditors can determine the correct amount of the appropriation by examining the bond indenture agreement. Another important consideration in the audit retained earnings is evaluating whether there are any transactions should have been included but were not. Okay, for example, if the client declare a stock dividend, the market value of the securities issued should be capitalized by a debit to retained earnings, and the auditor should evaluate whether it is still necessary to have the appropriation as the balance sheet date. Okay, that's all from us. Thank you. Bye.